Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow.
And welcome into the program. This is your Course to Retirement with Grand Rapids, resource for a common sense approach to planning with our money, with our investments, and for our financial and retirement future. He is certified financial planning professional Ron Corser, CFP, giving us some guidance and perspective on our money. And today, Ron, going to be talking about how money and investments behave and our behavior with them. Sometimes it seems like we do the wrong thing at the wrong time, and stress and market volatility, the stress that it causes, doesn't really help that too often, does it?
Well, I tell you what, I'm smiling here because when we talk about how money behaves, what comes to my mind is like my 2-year-old, it's not behaving very well right now. So this has been an interesting 5 months, hasn't it, in the market? So ladies and gentlemen, we're going to touch a lot on market behavior, on what's going on with it, and some different ideas of what's happening. I think it's always important to try to figure out why things perhaps are going the way they are without getting into a talking head kind of TV program. But I think it's important to lay a groundwork for it. So if you have questions once listening to this, or if anything we talk about in the next hour, kind of get your opinion up there and you want to talk about it, give me a call at 616-301-2581. That's 616-301-2581. Or please go to our website, www.cornerstone-rp.com. Put your name, how to reach you, and we'll reach out to you and give you the information you need or help you with an answer for a question you may have. So again, give us a call at 616-301-2581. So Peter, here we are. Summer has finally hit Michigan. It's like, wow, it finally happened. Now everybody's starting to think, well, maybe fall's going to be around the door, because when you live in Michigan, you never know what's going to happen.
It seems to happen
like
that
the
way.
Stock market, you never know.
Yeah,
you
true.
really don't know. So we're going to talk about the transition, the things that are going on right now a little bit in the market, and some interesting ideas of not so much timing the market, but understanding the time or the season that we're in, that you're in as an investor. What do I mean by that? When you don't have to take money out of your life savings and you're putting money in, there's an interesting concept called dollar cost averaging that seems to work to a lot of folks' advantage. What is dollar cost averaging? It's a very simple idea that says on a regular basis, annually, generally it's done on a monthly or quarterly basis, you put a specific amount of money into buying things in the stock market. We do this all the time. For those of you listening to today's program who are in a 401k or 403b or some kind of retirement plan that you're actively contributing to on a monthly basis, you are doing what's called dollar cost averaging. That simply means, let's say you put $100 in every month into your 401k plan. Well, when the market is high, like it was in January, you buy fewer shares with that $100 or whatever you're investing in. Now, if the market's being down dramatically, that $100 is buying more shares. The advantage to that is simply that when the market does turn around, and ultimately it will, those shares that you bought at a lower price will appreciate faster and higher than the shares you bought in January. So that's dollar cost averaging while you're working and you're not taking money out of a retirement plan. So what happens when you retire and you're no longer putting in that $100 a week, a month, or whatever you're doing? Then it's kind of, it's dollar cost averaging in reverse. Now you have to start selling shares of your retirement plan to provide income that you need to supplement either a pension or Social Security payments. So now it works in reverse. And that can be kind of painful, particularly in a situation we've been in this year where the markets are volatile, they're going down. It means that you're selling more shares of a particular mutual fund or investment than you would normally do in a market that was a little higher or not quite as volatile. So this whole idea of dollar cost averaging, it's a two-edged sword. It works really well when you don't have to take money out of your retirement plans because you're still working. It kind of works in reverse when you're no longer working and you have to start taking money out of your retirement plan. So let's talk more about this and how it works, why it works, and current market conditions. Give us a call, 616-301-2581, 616-301-2581, or please go to our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. Put your name, number in there, how we can reach out to you, and we'll contact you as quickly as we can.
616-301-2581. Once again, the number to reach Cornerstone Retirement Partners, as so many proactive savers, investors, retirement-minded individuals and couples from across Grand Rapids and throughout all surrounding areas have done for some guidance and perspective on your money, on your investments, and on your plans for retirement. To get that plan put together for that strategy session, that forensic financial analysis, you can give Ron Corser, CFP, a call, and he and his team look after the health and the wealth of their clients, making sure that you've got a common sense approach to achieving your important financial goals. And they take care of a lot of the details after you have a understanding of your money and the investment options that are available to you. Again, if you've got questions, give them a call, 616-301-2581, 616-301-2581. Ron, it sounds to me like essentially we are talking about behavioral investing, behavioral economics, and what we do, the emotions and the reactions that we have when we see these different scenarios. And there's kind of three different market conditions, right? Up, down, or sideways. And there's three different potentials for what we could be doing with our money, where you're either contributing, sitting or riding it out, or we're distributing, creating income. So total kind of a grid there of 9 different potential scenarios if we include our behaviors and then the market behaviors and the combination of the two and what that results in. And so going to be talking about that. Before we get into that, though, are there any, I think, main drivers of what we are going through currently in the market that you are paying attention to, or that you believe are resulting in this volatility, or that we might see some resolution to the volatility anytime in the near future?
That's a great question. It's a good lead into what I think we need to touch base with as to why is this happening now? Why do we had such a great run up last year? And why, since the 3rd of January, 2022, why have we had such a, what we might call a negative or bad result here in the markets? So let's just step back for a moment and talk about what from my opinion, are the two major driving forces. Number one is we have pretty high inflation. I was going to use the word rampant, and then my brain said, no, Ron, don't do that. But I'm going to use that word. I mean, we have inflation that's slowly getting what I think is more out of control. And people will talk about the market saying, well, they can handle a little bit of inflation, a little bit of inflation's good. And there's probably some background for that you could say yes. But when we get into the 8, 9, 10% inflation places, that's not good. It's not good for the economy. And ultimately, it's not good for corporate profits, which can tend to drive the markets. So why would corporate profits be hurt by that? Think about this. Companies, particularly the larger companies, have had what we call pricing power. They've been able to raise prices. We see that in the grocery stores. We see that on the new car lots, the used car lots. Prices have been able to go up. And over the last 6 months, 8 months, 10 months, the cost of replacement, say, for inputs into whatever a company is making hasn't gone up as fast as their ability to raise prices. So they've been able to raise prices faster than costs have come into them. But they're starting to run into kind of like the ceiling of how high can we raise prices before people quit buying what we're selling. So that means if they can't raise prices as fast as they have been, and the inputs, the cost, inflation, which is impacting what they need to buy to create whatever it is they're selling, goes up faster, that squeezes the difference between what they can sell it at and how much they make it. So profitability is always a main driver in the stock market. And when companies, particularly some of the big tech companies, start to announce that they're not doing as well as they had hoped, it impacts the market. So that's the first thing that's going on. But here's the other underlying situation that's going on. And it's a $12 phrase. It's called quantitative easing or quantitative tightening. What in the world is that? Well, that's a word that was created back in 2008. Ben Bernanke created it, and we all had to look at the dictionary and says, what does it mean? It's Fed speak. When 2008 hit and we had the great financial crisis, the thing that saved the whole world basically was the Fed's ability to just generate money. How did they do that? They basically bought securities, treasury bonds, market-backed securities. They even started buying some stocks allegedly. So they bought a lot of stuff, which means they paid money for it. They put money out there, right?
And Ron, I think that a lot of people imagine that they crank up those old printing presses and dollars start shooting out. But actually, a lot of that these days isn't even done on a printing press or with actual bills. It's kind of just done digitally, if I'm not mistaken.
Yeah, it is. We use the printing press as a euphemism for everything. But this quantitative idea, quantitative easing, means they needed to put money into the market. It's not what the government has done this year, say with, let's just create $2 trillion and send it out there. We printed that money. But the Fed is doing something. Now, with inflation kind of going through the ceiling, they've tried to pull back. And what are they trying to do? They're trying to take cash, liquidity, dollars out of the market to hopefully slow inflation and the other cost of just being in the world. That's called quantitative tightening. It's the reverse of quantitative easing. Instead of buying treasury bonds, mortgage-backed securities, and sometimes stocks, what they're doing is they're selling it, forcing institutional buyers to buy these securities, which takes money out of the system. And they're doing that hopefully to keep interest rates from rising too quickly, and also to kind of tamp down potential what they perceive to be inflation. So that's what's going on in the system, but there's a whole lot of other things going on too. These are probably the two biggest. What the Federal Reserve is doing right now, selling securities to take money out of the system, and also raising interest rates to try to tamp down inflation. But let's keep in mind something really serious, really basic information. If inflation is around 9%, and they raise interest rates up to 1%, is that going to do much to curb inflation? My opinion, I'm not an economist, but I played one on a TV show a long time ago. My opinion is that to really get at inflation, they're going to have to do what was done back when Jimmy Carter and Ronald Reagan were presidents, when we had rampant 14, 16% inflation. The guy just came in and raised interest rates through the ceiling, and that killed inflation in about 2 years. It also put a real big damper on the stock market, and we went into a profound recession. So the Feds are between a rock and a hard place. They created the problem by keeping interest rates so low, so long. It was cheap money. Anybody could get into the market and make some money. It was easy. Now that they're doing the reverse, it's painful. And it's painful for all of us as citizens. We don't have to be an investor in the stock market to know the inflation that we're experiencing is very painful. So these are some of the things that are going on right now, and some of the main drivers of why is gas going up? Why is real estate prices starting to maybe come down a little bit? Well, mortgage rates have gone up. You know, a year ago or so, a mortgage was about 2.5%. Now it's about 5%.
Mhm.
That will dampen the mortgage market eventually. So we're facing all of these things coming at us. Yes, we have that thing going on over in Europe. We have a whole bunch of other stuff going on. There's a lot of things that are coming together almost in a perfect storm to impact the stock market, our economy, and the worldwide economy. But keep in mind that the two primary drivers that we're looking at, or we're focused on, is what's the Fed doing in terms of interest rates, and what are they doing with quantitative tightening as opposed to easing.
And Ron, the federal government, we may think being able to raise money in kind of one way, which is taxation, but they actually have two tools, one being taxation, but the other issuing debt in the form of IOUs that are bonds and treasuries. And for institutions and individuals that have some capital that want to make some kind of return on that money, they can essentially loan it to the government. When they issue these bonds, these requests for IOUs, they can give their money to the government, and then the government has some operating cash. The interesting thing here over the last several years, really since 2008, is that the government has not only been issuing more of these, but simultaneously the Fed has been buying them up. They actually have $9 trillion of these treasuries and bonds on their balance sheet. Now the government is slowing down in the rate that they are issuing them, and instead of buying them up, they're trying to sell them. It's really creating kind of a constrictive environment on the cash and the capital that is available for banks and financial institutions to borrow. And that has ripple effects in tightening the cash in individuals' pockets as well. So it's a totally divergent direction from what we have seen really over the last 14 years or so. And the market tends to not love abrupt or big changes and big shifts. And so I think that the volatility, as the Fed changed their direction and their stance, the ensuing volatility in the market could have reasonably been somewhat expected, wouldn't you say?
Yeah, it should be, and it can be, and it must be. But unfortunately, I think sometimes the Fed has a different perception of reality. If I can just digress for a moment, think about this. Keynesian Economics says the Fed, by raising interest rates or lowering interest rates or printing money or pulling money back, they have the ability to dictate how people respond in a giant market. And they have mathematical models that prove that to be true. The problem comes when we think about there's about 340 million people in the United States with 340 million different approaches to how they use money. So it's almost as if they think they can tell everybody and figure out how to modify behavior for 340 million people when they can't predict what's going to happen tomorrow in the weather or what's going to happen in Europe or anything like that. So it's an interesting concept. People will always make decisions that's in their best interest. The problem with the Keynesian people is that they don't know what the best interest is for the people. They just assume certain things and they try to model it and prove mathematically that can happen. So as individual investors, what are we faced with? We're faced with a situation, we're looking at our life savings and saying, we have worked so hard, so long to accumulate this. And now we need it in retirement to maintain our lifestyle. And the government folks are doing weird and wonderful, strange things, thinking they got a handle on this. And we're sitting back as consumers and as investors saying, what in the world are these people doing? That is really dumb. Oh, we're going to forgive debt. Seriously? We're going to do strange things like that. And so there's a real giant disconnect between how you and me and people listening to today's program look at their money, look at their life savings, look at how they spend, versus how these high-priced intellectuals hiding out in a building in Washington, D.C. kind of take a look at it. So what's really important, ladies and gentlemen, is to understand There's things going on over which you and I as individuals have no control. So it's not so much that we need to just rise up and complain about it. The key issue is, what are we going to do? How are we going to respond to this? And that's what I want to spend the rest of this program on, is how are we going to respond to this? What are we going to do? Yeah, there's some bad news out there. Is it going to last forever? Nothing ever lasts forever. But as a human being, we think, well, what happened today and what happened yesterday is going to happen tomorrow. So we're going to get through this. The question is, while we're trying to get through this, what are we going to do? And there's as I said, 340 million people, there's probably 340 million opinions and options. So I'm just going to kind of come at it from my point of view and some of the things that we can do, some of the things we need to understand. A lot of what we need to do is understand more about money in motion, about what happens when money goes in motion, what happens when it starts moving around. If we start to understand that, we start to have a greater understanding of what our money can do, should do, or what we have to protect it from. So that's what I want to go forward here on the rest of the program. Ladies and gentlemen, if any of this is making sense to you, you have an interest in it, please give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your information in there, name, how we can reach out to you, and we'll reach out to you and try to help you work through some of these things that, even for me and a lot of other people, they seem kind of confusing. But if we just take a step back and look at them, we can try to make some sense out of them and figure out what's the best plan of attack, so to speak, to maintain your lifestyle, to hold on to your life savings, and to work through this tough time, because a good time is coming down the road. I just don't know when it's going to be, but we'll get there together. If you'd like us to help you, give us a call, 616-301-2581.
Or you can visit online, cornerstone-rp.com, cornerstone-rp.com, or again, a call to the office at Cornerstone Retirement Partners, 616-301-2581, 616-301-2581. Ron, you mentioned 340 million different ways that we can look at different approaches to our money, but according to the information you sent over prior to the program and some of the charts, we're going to try to boil that down to 9 different ways based on how the market is moving, either up, down, or sideways, and then what we are actually doing with our money, which is 3 categories: either contributing, holding or riding it out or sitting, or the third option, distributing. So based on the direction of the market and then the direction or the behavior that we are implementing with our money, there are some things that we should know and some likely outcomes. So let's talk about these directions of the market and what they mean based on what we are actually doing with our money.
Okay, and I think a good intro to that is to think about what impacts the market. We've already talked about profits. We've talked about the ability to raise prices, cost of inputs. There's another thing that's working here in the market that doesn't get a lot of attention, or at least enough, I think. And that's something called demographics. Boy, that sounds serious, like there's a disease there and there should be a shot for that. But really, it's just talking about what kind of population do we have in our country and every other country. It's ages. It's really a simple concept. It was really brought into the forefront back in the 80s with a guy named Harry Dent. I was a part of the Harry Dent kind of elite advisor group, and he did a lot of interesting studies. And one of the things he predicted back in the middle to late 80s, and he was, oh man, did he get beat up over it. He predicted that Japan would have an enormous financial crisis, and they would go into a depression. Now, this was when in the late 80s, when Japan was going to take over the world, and everybody thought that they were going to be the next big dog.
Yeah, they were thought to be the economic model for efficiency, and that they were going to be an ensuing superpower as a result of the strength of their economy at one point.
And that didn't work out too well, because in 1990, the Nikkei cracked. And frankly, they've been in a depression or recession ever since. The Nikkei has never gone back to 40,000. They have enormous debt problems, and they have a declining, what I might say, young population. Here's what's going on in Japan, which is going on in a lot of other places in the world, is that their population is aging. They're getting every day more and more old people, and they're using young people to supply the benefits to the old people. So we have an economy that's about 70% based on consumer spending. So we know that as we get older, we don't buy a second or third house. We don't buy a second skidoo. We don't buy another cottage. I mean, generally by the time the kids are out and we're in our 60s, we're mostly done buying stuff. Now we just want to enjoy life. But if spending is a function of 70% of our economy and the spending starts to slow, then we're going to have some economic problems. That's what happened in Japan. It's happening in Western Europe. It's happening in a lot of places. So he predicted that the markets would go to 30,000 and then they would crack up. Well, he got a lot of grief because the markets didn't do that when they were supposed to based on his timing. And the reason for it goes back to what we talked about in the beginning of the program, quantitative easing. In all of his calculations, and frankly, in everybody's calculation, what happened in 2008, 2009 with governments printing, spending money, quantitative easing had never, ever been done in the history of mankind before. So that was one of those unknowables. You can't figure it out because you didn't think it was ever going to happen. But we still have a demographic wave going on in our country. Now, one of the things that is, and this is going to aggravate some people, and I don't mean to do it, but one of the things that makes the United States a little different than some other places is that we have uncontrolled immigration. Some of that's not good, some of it's frustrating, but what it is doing is mostly people coming into this country are young people. There's not a lot of 80-year-olds coming into the United States. So what's going to happen is that ultimately a portion of these young people are going to become citizens, they're going to become contributors to our economy, they're going to pay taxes, and because they're young, the vitality of our country demographically has a potential to increase over time. Now, that brings a lot of other stuff, and that's a political argument I don't want to get into. But demographically, we're not as in bad shape as some other places. So when we look at what's going on right now, people say, okay, it's been an ugly first part of the year. What am I supposed to do, Ron? Well, here's a couple things we're going to talk about if the markets go up, if they go sideways, if they go down. And that is, how should you respond? We have been taught to buy and hold as clients. We have been taught that you just buy good stuff, and we assume that all the mutual funds in our 401k or IRA are good stuff, and just hold them because the market always comes back. And that's true. But when we come back from break, I'm going to talk about a concept called sequence of returns risk. And it's a risk that people coming into retirement or just into retirement, this 3 to 4 years before and after, the red zone, where sequence of returns risk, buying and holding, can be a really, really terrible strategy because it can become really expensive. So stay tuned. Give us a call if what we've talked about makes some sense. 616-301-2581. 616-301-2581, or please go to our website, www.cornerstone-rp.com. Put your information in and we'll reach out to you. But stay tuned because we're going to talk about sequence risk. We're going to talk about what should we do when when the market goes and money goes sideways, up, down, and every other which way. Stay tuned.
Well, I don't know about you, ladies and gentlemen, but what Ron Corser, CFP, talks about on this program tends to always make a whole lot of sense to me, more sense than a lot of the financial jargon that I hear out there. So great perspective, understanding of our money and the market and finance and how it all works so that we can make well-informed decisions with our money to help us achieve and accomplish our financial goals and make sure that every dollar is working its hardest to help in that cause. If you've got questions about your money, about whether your dollars are working to help you achieve those goals, if you've got them set up and structured properly, pick up the phone, give Cornerstone Retirement Partners a call, 616-301-2581, 616-301-2581. Quick break. We'll come back. We'll Learn more from Ron Corser here on Your Course to Retirement in just a moment. Welcome back to Your Course to Retirement, the weekly show with Grand Rapids Resource Certified Financial Planning Professional Ron Corser, CFP, founder of Cornerstone Retirement Partners. And today we are talking about the market. We're talking about what we do with our money. We're talking a little bit of behavioral finance and what we should consider when making the decisions of buy or hold or sell based on the direction of the market. Ron, it's kind of interesting that we hear all of the pundits say buy and hold long term, that's how you make money. And then on the other side of the coin, you don't lose money unless you sell. So holding is the secret to making money, but selling is the secret to losing money. Those seem to be in conflict to me.
You know, let's think about the stock market as a casino. I think it's a great analogy. Maybe there's not quite as risk in the market, but there can be. So you walk into a casino and you take $1,000 into there. Now, when is the best time to get out of the casino? I ask this question all the time.
When I still have my $1,000.
It may be $1 more, right?
Maybe, yeah.
You got to hold on to what you had, and maybe you got $1 more.
I got a free drink, a free meal, and I'm out.
Absolutely. So what happens if you take your $1,000 and you sit, and I've been told that the best odds in a casino are the blackjack tables. I'm not a gambler, so I don't know. But let's say you sit at the blackjack table forever. The odds of winning are 47%. That's what I've been told. That means the house has a 53% chance of winning. So if you sit at the casino long enough playing blackjack, what do you think is going to happen to your $1,000? Chances are, odds are, if you stay there long enough, you will lose it all. Just common sense. So let's use that analogy with the stock market. There's an idea out there, and I hear it a lot. I don't use it with people, but I hear it from folks that we see for the first time. Or the broker says, well, you can't sell it because it's not a loss unless you sell it. So my question then becomes, okay, let's pretend you had $100,000 in your IRA. You haven't sold anything, but given the market correction, now you have 80,000. Here's a really simple question, a simple test to see if this idea is true. You started with 100, now you have 80, you haven't sold anything. Have you lost money? Do you have less money today than you started with? Chances are you have to answer in an honest way. You have to say yes. So it's not an issue of a paper loss. That's what people say. Well, it's just a paper loss. No, you've lost real money. Now, if you had $100,000 and it went down to 80, here's some real arithmetic. How much does the market have to rebound? The market's down 20%. Your 100,000 went from 100 to 80,000. What happens to the stock market just for you to get back to even? It has to go up 25%. From 80 to 100 has to go back up. There's no other way to do this. So one of the interesting things about this paper loss idea is I tend to say it's not exactly accurate. It's more designed to make sure that people stay fully invested in the market from the broker's point of view. So let's take a look at the other issue. If it's not a loss unless you sell, how do you get a gain out of the market? Well, here's a little arithmetic question. You invested $100,000 into something, and now it's up to 150,000. You've got a gain, don't you, of 50,000? But how do you realize that gain? What do you have to do to realize that gain? You have to sell that security. Look at it from a marketing point of view when it comes to housing markets. You know, we had an enormous run up here in the housing market. And I'll ask clients, how much is your house worth? Well, we think it's worth 300,000, but probably get more in this market. I tend to agree with it. So how are you going to know what the real value of your house is? Yeah, you'll ask a real estate agent, he'll put a number on it. But you don't know how much your house is really worth and how much profit you're going to get out of that house until you sell it. It's the same with stocks. You can have an increase in value in the account, but until you sell that security or that mutual fund or whatever it is you got, and you reap the profit, you don't really know how much money you made.
No, I think that is a great analogy that people can absolutely understand in the current housing market. Is maybe our house increased by 20% in value this year, but if the price goes back down and we have not sold, did we actually make any money? And the same is true for your Vegas casino analogy. If we do end up with our $1,000 starting off on fire and we have wins early on, so 1,000 turns into 1,500, but then we sit there until that 1,500 dwindles back down to 1,000 or $750, did we actually make any money? And unless we walked away from the table, we did not. And I think that a lot of people understand those two that we're comparing it to, the housing market or the casino analogy, but maybe don't equate that to the investments that they have and the balance that they have inside of their 401k. Yes, Ron, it's true that we have not lost until we sell, but we also have not truly gained until we sell and realize that transaction. And I think that is an important factor for all investors, really, to get a better understanding of, is that works both ways.
It really does. And here's where the tough part comes for investors. Those that had a run up and made some money through, say, 2021, they've maybe they can have a 30% gain in something. And they don't want to, it's normal human behavior not to want to sell a winner. The other part is if we hold this winning account, this security in a taxable account, if we sell it and make a profit, there's going to be a tax consequence to that. Just like if we sell something at a loss in a taxable account, there's a tax consequence. What I hear sometimes is people have had a nice run up when we meet them for the first or second time. They've had a nice run up in their portfolio, but they're not getting the kind of advice or service or care that they think they get, which is why they sometimes call us and come in and talk. And the question becomes, you've had a gain. What do you want to do about it? And you kind of get this quizzical look and I say, well, how do you feel about selling some of these gains that you have and perhaps reallocating from where you are into something that may make more sense today, given what's going on? And the response that I hear quite a bit was, well, I talked to my CPA about it, and he said the taxes are going to kill me. I can't sell. So, okay, let's go through some arithmetic here on a radio program again. You bought something for $100,000. It's now at $150,000. You don't want to sell it because that $50,000 in a taxable account is going to be a capital gain, which will be taxed at somewhere between either 15 or 25%. So the market's down about 20% already. So now, instead of having 150,000, you have 130,000. You still haven't sold anything. If you were given a mulligan in this market, what would you prefer to do? Sell when it is 150,000, or hold on it as it's going down 130, maybe going down a little farther, and still sell? I mean, what would you rather do? And see, that's where the rub comes in. It's always about, we ask this question a lot. We think it's key. What is it you want your money to do for you? Well, I want it to grow. Well, how are you going to grab that growth if it happens? You're going to have to be in a position to sell some of those things that you've made money on. If it's in an IRA, it's not a big deal from a tax perspective, but if it's in a taxable account, it's an important consideration, but the tax issue shouldn't wag the dog, so to speak, from my point of view. I would rather have a $50,000 gain on a security and pay a 15% capital gain than have that security go down 25%. And I had left some money if I'd have just sold it to begin with.
Well,
So
Ron,
those are some of the things to think about.
Bank of America states that there have been 19 bear markets in 140 years. The average bear market duration, 289 days. Now that is the downside movement. That is just from the top to the bottom. That does not include recovery time. The average decline in those 19 different bear markets, a negative 37.3%. Now, to put the massive outsized gains from the last 12 years in perspective, we've already seen market volatility, but another 10% decline from here would only take us back to about the levels from October of 2020. A 20% fall from here would put you roughly back to June of 2020. A 30% decline, further decline from here, would only put us back to the levels that we were at around April of 2020, and a 40% free fall would only wipe out the gains since early 2019. In fact, the index could be cut in half, and we'd only be back to about 2018 territory, to put things in perspective. So do we feel like we have further that things could fall? I mean, potentially. And we know that the market can go up, but it's what we are doing with our money during these periods that really determines what our resultant outcome is.
Yeah. One of the things that this market has done, I think, in the last 5 months or so, is it's really pointed to the need when creating an investment strategy to have what's called a downside investment strategy. How do we buffer our money? How do we buffer our investments? I know that we can just buy an S&P 500 fund and get all the market, all the up and all the down. Right now, having an S&P fund that you bought, 500 fund from 1st of January to today has been painful, really painful. So the question becomes, we know that the market's going to continue to be volatile. Why don't we think about doing what some of the Wall Street firms do and investors do, is when they invest, they think about, okay, the point here is to make money, to have a profit. But what about if we're wrong about the direction of the market and it goes down or just goes sideways instead of going up? How do we buffer our investments? One of the things that we encourage our clients to do is when creating investment strategy, we ask a couple really simple questions. Number one, what's the purpose of this money? Meaning, how much extra income do you need from it? What kind of rate of return do you think would be reasonable? And what kind of strategy do you want to put in on the downside to buffer some of the downside, so that if the markets go down 10 or 15%, you're protected somewhat? It's a really important question to ask. And it's a really important strategy to talk about with people to figure out how we can protect some of the downside. Because most people, I think, would say, I'll trade 10 or 15% protection for the downside, and I'll give up 5 or 10% of the upside. To protect my money, if the markets turn around tomorrow and go back up, I'm going to make money. But if they continue to go sideways or down, there's a level of protection built in. Now, I'm not saying this strategy is correct for everybody, but I'm saying it's a strategy that should be looked at as part of the overall investment strategy for your life savings, for your portfolio. Is yes, we can always plan. It's easy to plan on the markets going up. Much more difficult to say, what are we going to do if they go sideways or if they go down? And I think sometimes if we look at history, ladies and gentlemen, we can maybe get a sense for this. Now, I'm going to ask everybody listening to today's program if what I have said or what we're about to talk about is going to make sense to you. Give us a call at 616-301-2581, 616-301-2581, or please go to our website, www.cornerstone-rp.com. It's www.cornerstone-rp.com, and put your information in there and we'll reach out to you. Now, what am I talking about with the direction of the markets? Let's go back in history, because earlier you talked about, Peter, this bull market and bear market stuff. If we go back to 2000, everybody kind of put their thinking cap back on and go back to January of 2000. You know, the world was a wonderful place. We had the internet going crazy. it was going to be different this time. Companies were being sold at multiples, almost to infinity. The internet was going to change everything we knew. And then all of a sudden, it quit working. And we went into a 2000, 2002 really bad recession. Part of that was also the result of 9/11. Those things happened. So as the decade kept going, then we ran into another 2000, 2009, 2008 market debacle with mortgage-backed securities. So when we look at it, if you would have retired on the 1st of January 2000 and had all your money invested in the stock market, when would you have gotten back to even? You stayed in the market. It was a buy and hold strategy. You did what your broker told you to do and everything was dandy. Well, you wouldn't have got back to even until January of 2013. Think about this. January, I'm reading this, the S&P was at 1469. It hit 1469 again in January of 2013. So we went to 12 years of basically flat. And how do you cope with that? Do I think this is going to happen again? I have no idea. I have no idea what's going to happen this afternoon, let alone what's going to happen over the next 10 years. I can guess, but as an advisor, as a fiduciary, what we try to help our clients understand is that when we don't know what the future holds, we have to make some assumptions. And we have to say, yes, we want our money to earn money. We want it to grow. But what if the markets go sideways or down? Is there something built into our strategy that will protect us on the downside? And that's where we can be a great help to you, ladies and gentlemen, to create strategies that give you the opportunity to have a fair rate of return over time, but also give you the opportunity when things don't work out, when the government does stupid stuff, or the world just kind of rolls over on us, to protect some of that hard-earned money of yours in your life savings. So if this is of interest, give us a call, 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com, and we'll reach out to you and we'll help you do the very best we can, given whatever it is you want to try to accomplish. But above all, we want to make sure that whatever plan we help you put together not only makes sense for you, but gives you some peace of mind, if you will, no matter what the markets do, up, down, or sideways. So give us a call, 616-301-2581. Be more than happy to reach out to you and help you.
616-301-2581. You can also go online, cornerstone-rp.com, cornerstone-rp.com. Lots of great resources available on the website, tools, calculators, reports, and previous editions of the podcast as well, where we talk about great information and always helpful links and tidbits in the show notes as well there, ladies and gentlemen. Ron, you mentioned that we don't know what the future of the market may hold. But what I like is that we can look back historically and see what the result would have been using real world market conditions based on whether we are contributing, whether we are holding, or whether we are taking distributions. And we have a good enough sample size here that we can see what those results would be in up markets, down markets, and sideways markets. So getting into this, there first needs to be a cognitive recognition that the results from our money is going to change based on what we are doing with it. Whether we are contributing, whether we are holding, or whether we are taking distributions and income. And you've got the chart and the data that you provide all the way back to 2000, all the way through end of calendar year 2021. And the results are pretty remarkable here. I mean, you've got one column where we're making contributions, one where we're just holding $100,000 for an example here already invested, and then one where we are taking distributions. And for the first 3 years, I think this is incredible. Where we are making contributions, we would have put in $10,000 a year, and by the end of 3 horrible years in the market, we essentially have what we put in. We really didn't lose all that much. We still have $29,000 after losses of 10%, 13%, 23%. That's actually pretty good in my assessment. With our $100,000, if we're just holding, the 100,000 has actually turned into just below 60,000. We've lost about 41% of our money. We're sitting at 59,000. And if we're taking distributions, the results are even worse. Even at a modest distribution amount there, Ron. I don't know which way. I think they mean about the same thing.
It's an interesting idea. And ladies and gentlemen, I know we're talking about numbers here and charts, and it's pretty difficult on a radio program to do that. So if you would like to see the chart that we're talking about that says what happens depending on how you're investing or what you're investing in, give us a call. I'll send this to you. It's a nice colored chart. Basically, it says quite clearly that depending on when you started to invest and how you're investing, that will ultimately determine what you end up with. Even though the markets could have gone up over the last 20 years, the outcomes of your money is very different. And the key is, it's easy to keep putting money into the market, investing in a 401k or 403b on a regular basis. I encourage everybody to do that. The difficulty comes when you have to stop doing that because you're unemployed or you're retired, and now you start taking money out. See, the key, a lot of what we hear from Wall Street when mutual fund companies say, well, if you had just stayed in the market, you'd be back to even or this much you had. They never assume that you're taking money out of your life savings. It's always we started with 100,000 in 2000, and now we should have 300,000. See, if you'd have just stayed the course, you'd be just fine and dandy. Except if you're taking money out of the account, that changes the equation totally. I'm just gonna summarize this chart. If you started with $100,000 and didn't do anything for 21 years in the market, just leave it at an S&P 500 fund. After 21 years, you'd end up with $292,649. Now, this is just simple returns. If on the other hand, you started with $100,000 in the market and you were taking out 4% or $4,000 a year, after 21 years, you've got $35,259. It does matter where you are in this idea of, am I putting money into my investments and not taking money out? Or am I not putting any more money in and taking money out? It makes an enormous difference. You have recovery time, right? You do. You can have a bad market right now. And as long as you still got time to recover and invest more, you're probably going to be okay. The problem comes for somebody who retired this year in January 1st. Unless they have created a portfolio, a strategy that buffers some of the downside and protects a portion of their money, they've got some pain going on right now. Some real serious pain in their life savings. So if you want to see this chart, we'll email it to you. Just get on our website, go to www.cornerstone-rp.com. Put your information in there, we'll send it to you. If you just want to call the office at 616-301-2581, we'll send it to you. I think it makes great sense to take a look at this to understand where you are in your own life cycle. Am I putting money into my investment accounts because I've got 5, 10, or 15 years to go before I take it out? Or am I getting to the point in time where I have to start taking money out? It makes an enormous difference in outcomes and means that you really need to do different kind of planning when you get into that distributions phase of your life savings, as opposed to when you're just putting money in. So please give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your information in there. We will send you this. It really is a neat document to take a look at. It's an eye-opener. So I hope you take advantage of this offer.
Ron, the chart is great. It really is eye-opening. However, the key to this is that when we are doing different things with our money, we should actually treat it differently. Whether it is sitting and we're holding, whether we're contributing, or whether we're taking distributions, we need to understand that those implications have ramifications on the results. And so there are a couple opportunities as we are closing out the program. I want to emphasize this, that there are key milestones in life where we can change course with our dollars and then treat them differently. And a big one is age 59 and a half, and another one is rolling over previous accounts. And if what we are doing with those dollars have changed, if we're no longer contributing, or if we've already built and accumulate a large life savings inside of a plan, we need to pay attention to and heed these critical milestones in order to get optimal results.
Yeah, we do. And the key is 59 and a half that you talked about, because for most plans, that allows you to do what's called an in-service distribution. What is that? That's where you can take some or all of your money out of your 401k. You don't get out of the 401k plan. You can still, if you're still working, you can still contribute, but you move that money into an IRA. It's not a taxable event. Why would you do that? Well, when you're in a 401k, usually an employer-sponsored plan, most of the investments are designed to succeed in one direction when the markets go up. You don't have a lot of different strategies to deal with. When you move that money into an IRA, you have a wide world of things in which you can consider to apportion some of your life savings into. You can really get into the diversification model much more deeply and much more effectively, and also be able to buffer perhaps some of that downside. So that's a great thing to think about when you're 59 and a half or older and you're still working. You're not going to get out of your 401k or 403b. It's just going to allow you to move money into an IRA, where with somebody's help like our firm, we can help you going forward and how to create a strategy that fits today's market, that might fit tomorrow's market, or 10 years down the road market, that kind of a strategy. The other issue is that if you've got some accounts laying around, what we call, you got 2 or 3 IRA accounts or an old 401k from an old employer, chances are you're not getting a lot of advice on how to handle these accounts. Sometimes it's a really good idea to meet with us, and we can take a look at all the different accounts that you have and try to figure out, does it make sense from an investment strategy and also a cost strategy to combine some or all those accounts into a minimum number of accounts, maybe just one. Makes it easier to manage. It might be less costly, but it gives you a wide variety of investment options that you may not have access to because you don't have somebody helping you. You don't have an advisor for some of these things. So if this is something that you've got out there, 2 or 3 accounts, sometimes I've seen as many as 8, give us a call. We can help kind of put them all together in a rational, viable way that makes sense to you, that gives you the best opportunity to have a gain if possible, but also to minimize whatever bad news may be out there. Give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your information in there. We'll reach out to you and try to set up a time to at least chat by phone or the internet, doing Zoom or in person. But we believe we can help you with these things.
Again, if you would like to take advantage of all the resources of Cornerstone Retirement Partners and of the guidance of certified financial planning professional Ron Corser, CFP, if you'd like to have that complimentary review, that analysis, that forensic financial dive into your current investments and accounts, and then a strategy session to plan what you should be doing to accomplish your goals into the future, just reach out. 616-301-2581, 616-301-2581. Ron, always enlightening, informative. Thank you for the guidance and education that you provide here on the program, and then to individual savers and investors proactively trying to achieve those important financial goals.
Well, thank you, and thank you for everybody listening to today's program. I hope you have a blessed Sunday. If you want this chart, give us a call or go to our website. But be grateful for what we have. Summer's coming. I think summer's coming in Michigan. It should be okay. But have a blessed Sunday, and I'll talk to you again next week. Take care.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement, Sunday mornings at 9 o'clock at News Radio WOOD, or visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the products featured